The U.S. Securities and Exchange Commission has filed charges against a Texas man named Nathan Fuller for allegedly running a $12.3 million AI crypto trading bot fraud. The SEC alleges that Fuller marketed fake AI-driven bots with promises of high-frequency returns, but in reality, only about 3% of the funds were used for actual trading. The rest was allegedly siphoned for personal expenses and Ponzi-style payouts to earlier investors. This case is part of a broader pattern of AI crypto fraud, where operators use the buzz of artificial intelligence to attract retail investors with misleading claims about automated returns. The SEC's filing reveals that approximately 150 investors were affected across multiple jurisdictions. These investors were drawn in with performance reports and statements that were fabricated or misleading. The operator allegedly used these materials to maintain the illusion of a functioning system while continuing to draw in new investors. The structure of the scheme allowed Fuller to accumulate a large sum of money, with $6.2 million reportedly spent on personal expenses and $5.5 million used for Ponzi-style payments to existing investors. The SEC's investigation found that the AI crypto bot system lacked the infrastructure to execute the high-frequency trading strategies it claimed to offer. Instead, the system was allegedly a facade designed to collect funds under false pretenses. The mechanism of the fraud appears to have relied heavily on fabricated performance. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Reports and misleading marketing materials. Investors were led to believe that their funds were being actively traded using advanced AI algorithms that scanned exchanges and executed trades at high speeds. However, the SEC alleges that these claims were false, and the system did not operate as described. The stakes for investors are significant. Many of them likely believed they were investing in a cutting-edge technology that could generate consistent returns. Instead, they were part of a scheme that siphoned their money for personal gain and to pay off earlier investors. The broader implications of this case highlight the growing concern around AI branding in the crypto space. Many operators are leveraging the appeal of AI to attract investors who may not fully understand the technology or the risks involved. This case is also a signal of increased regulatory scrutiny on AI crypto products and retail fundraising practices. Regulators are now paying closer attention to how these systems operate and whether they deliver on their promises. The next signal to watch in this space is whether more AI crypto operators will face similar scrutiny or if this case is an isolated incident. Investors should also be on the lookout for other AI crypto projects that may be using similar tactics to attract funding without delivering on their promises. The key takeaway is that AI crypto is not inherently fraudulent, but the lack of transparency and verifiable performance data in this case points to a broader risk for investors. As the market continues to evolve, it's likely that we'll see more regulatory actions and investor education efforts focused on AI crypto claims. The SEC's filing in this case is a clear warning to anyone using AI branding to mislead investors. The case also underscores the importance of due diligence when investing in AI-driven crypto products. Investors should look for verifiable performance data, transparent trading infrastructure, and clear explanations of how the technology works. Without these elements, the risk of fraud increases significantly. The SEC's action in this case is part of a trend where regulators are stepping. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. In more aggressively to protect retail investors from fraudulent schemes. The fact that the SEC is taking action against a specific operator in Texas suggests that enforcement is becoming more localized and targeted. It also shows that regulators are willing to act when there is evidence of fund misuse and misleading marketing. The broader implication is that investors should be cautious about AI crypto claims, especially when they promise consistent returns without verifiable performance data. The SEC's filing in this case is a clear warning to anyone using AI branding to mislead investors. As the market continues to evolve, it's likely that we'll see more regulatory actions and investor education efforts focused on AI crypto claims.